All right, everybody, welcome back to another episode of the Evernest Real Estate Investor Podcast. I am one of your hosts, Spencer Sutton, and I've got Gray Hall back here with me. Gray, welcome back to the show.
Happy to be here, Spence.
Yeah, glad you showed up. I wasn't really sure if you were going to show up today. I know you've got a lot going on.
I left the calendar invite unaccepted. It's just kind of surprised if I show up or not.
You do that.
Keep you on your toes.
I really don't appreciate that. So, no, I even told our guests that we may have a co-host, we may not, but glad you showed up. All right.
Man.
Well, let's introduce our guest. We're excited to have Jamison Manwaring with us, who is the CEO and co-founder of Neighborhood Ventures. Jamison, welcome to the show, man.
Hey, thanks for having me. Excited to be here and look forward to getting to know you guys more today.
Yeah, we're excited to learn more about what you're doing, and we love to start off the show. I mean, I think you have a really interesting background. Would love to hear a little bit about your background and how you got into real estate, and then we'll open up and share with our listeners exactly what you do.
Sure. Happy to dive in. I studied finance in college, University of Utah. Decided I wanted to be a trader on Wall Street. Got an internship out there. Realized quickly I didn't want to be a trader on Wall Street after doing it. But I ended up staying out there, worked with Goldman Sachs as an equity analyst covering software stocks. And so my team would analyze the different companies in the software space, and we would rate each company buy, sell, hold, and we put out EPS forecasts and earnings forecasts, and we would do meet with the executives frequently to talk about where their business was going. And it was a great education on financial analysis, how to read financial statements, how to pick between, in this case, software companies, which ones we thought would outperform, which ones wouldn't. And in the midst of doing that, I got a great education, but I also learned how volatile the stock market really was, because I was watching it every day, and especially the tech space. We would have companies report earnings, and the next day they would be down 30% or up 30%. And
right.
And I thought, wow, my clients, which were pension funds, mutual funds, have hundreds of millions of dollars ever at risk here with these types of fluctuations. And for me personally, it didn't make a whole lot of sense. And as I began to do some personal investing on my own, I realized I didn't want to play that game, that up and down game in the stock market with my hard-earned money. And so when I was out in New York, I ended up, my dad's a real estate broker. I'm from Idaho. It's where I grew up. And he had a listing. He said, hey, you should take a look at this listing. It was a 10-unit building. And I ended up buying that, even though I lived a couple thousand miles away, renovating it and going through that process, and really fell in love with real estate, in this case, multifamily real estate. And I love the consistent cash flows. I love being able to see the transformation as we renovated it. And as I ended up moving out to Arizona, I got a job opportunity in Tempe, Arizona, a company that I covered at Goldman after they went public, LifeLock. They offered me a job to move out to Arizona, and I was ready to get out of New York. So I joined LifeLock in 2015, and about 2 years later, we got bought out, and I had the opportunity to make a pivot and decided I had enough of the corporate world and wanted to do more real estate. And that's kind of the short story as to how I ended up here. I shortly thereafter, LifeLock got bought out and met my co-founder, who's a real estate developer, a multifamily developer in Phoenix. And we paired up and wanted to do crowdfunding for multifamily. We saw an opportunity to bring more people into investing in these projects with the new crowdfunding laws, which we can talk a bit about. And we launched Neighborhood Ventures about 5 years ago.
That's awesome. I'm interested to know, going all the way back. So you were at Goldman, and like, were you a trader at Goldman as well, or were you a trader at a different company? I'm just kind of curious, I know Goldman's very demanding. Like, what's the difference between trading? Because I know that's a demanding profession, as well as them moving into an analyst position. I would imagine both are very challenging.
Yeah, both are challenging, demanding. The trading environment, they work early hours before the market opens.
Yep.
And then they're real busy during the market. And then they tend to, after the market closes, they may not do a whole lot after that. So they're early risers and kind of work around market hours. When you're an analyst or in investment banking, you don't have to work around market hours. So the company loves that. So you can work all the time. And we ended up working, I was working 80, 90 hours a week for three and a half years. And everyone else is doing it too. So it felt okay. But for me, I knew I couldn't sustain that. Didn't want to try to sustain it. It's an interesting environment. It's kind of almost a military environment. It's good for you, but you don't love it. And learned a ton, had great experience. They treated me really well, have nothing but good things to say. But I was ready to move on from that as well.
Yeah, we've got a couple of Goldman alum on our team. Our CFO's Goldman, and then somebody else on our accounting team is Goldman. So we understand the challenging environment. So kudos. So you bought a 10-unit apartment complex. Talk about the decision to buy that from New York, across the country.
Yeah, I had never bought a piece of real estate before. I didn't own a home. I'm living in New York, renting a two-bath apartment with one of my buddies for $4,500 a month, which we split. Teeny 800 square foot apartment. And so when my dad sent me over the information, I knew how to build a financial model, and I knew how to look at revenue and costs. And so I got all the information and built one from scratch, just like I would on a company. And I said, are you telling me I can buy it for this? And in this particular case, the owner was a bit distressed, needed to sell quickly. My dad was the broker, so he knew the whole story. And I said, let's do it. It took me about a day to say, let's do it. And I needed real estate's great when it comes to taxes. And I knew I needed to start putting some money into an entity and doing some things. You're living in New York, you're paying 50% of your income is going to taxes. You got city tax, state tax, federal tax. And so I'm trying to figure out a way to have some tax strategies. And by buying the property, I was able to do that. And I knew I wanted to pursue it, and quickly made a decision, bought it right. I knew I needed to have some capital put aside to renovate it. And I found a contractor there who would do that for me. And then I found a local property manager. And it was actually a lot of fun, not as much stress as I expected. But I also knew that I didn't expect to make any money for a while. And I just wanted to see what would happen. I ended up selling it 3 years later and having a really good profit on it.
That's pretty abnormal. Most people takes a long time where they're doing a bunch of research and they're trying to understand the market, how you do this, and then they're looking at a bunch of properties. And jumping from 0 to 10 is not typically the path we see. I mean, a lot of people who get into multifamily, they might start with a duplex, a quadplex, single family, and kind of build up. Probably helped having your dad be the broker there. I mean, he's got some real estate experience, so you weren't starting from nothing. But a lot of the people that we've talked to on the show, the people who've scaled up really quickly or gone really big, they just kind of went for it. I think some of that's just kind of innate. And so you think it's some of your personality where you only had 24 hours, you made a decision. That's like atypical from a lot of people that we talk about. So do you think it's kind of how you're wired, or what else like made you comfortable with the deal?
Yeah. And I was one of those guys that read Rich Dad, Poor Dad when I was 18. And I had always been drawn to real estate. My dad's a broker, and he was a little bit upset that I decided to go the Wall Street route, but I didn't want to do what my dad did, right? Can't do that. So I didn't want to just go work for his company. I had a few other brothers that did, but we were always constantly talking about it. And then I was a financial analyst. And so I said, hey, if anybody can analyze this, it's me. And I put it through the Goldman model, basically, that I had learned there. And I said, real estate's actually pretty simple. It's revenue, it's expenses. If you're going to put debt on it, which I didn't, I put a little bit, actually, I did put a little bit of debt on it, but it was, 40% LTV or something. It was easy to get. Local bank did it. And quickly it came together. I did get lucky. I was also just kind of ready, chomping at the bit, wanting to do something besides stocks. And so it distracted myself from those 90-hour weeks. And I didn't go into it with, thinking I'm going to make $1 million. I didn't even look at the money. I was more wanting to see how the operations work and learn. And then it ended up working out well for me.
He also had the pressure of taxes, right? Like he was like, how can I save taxes? This will make me buy this now. I'll do it now.
And so many folks in New York, for example, and there's other places as well, but they get so head down on their career and they just get used to paying 50% taxes of their income, and they're making good income, and they're over time keeping very little of it. It's just all going out the door. And I, from how I grew up in the conversations in our home about what you can do with preserving some wealth and how real estate can do that, it was always in the back of my head. So it was something I was chomping at the bit to try to get into quickly.
What I do love is what you just said, I want to highlight it. You didn't go into this thinking you were going to make a bunch of money. You didn't really look at the numbers. Now, you didn't go into this saying, hey, I'm going to lose a bunch of money. You obviously did your diligence, but the first deal that people buy, I think you get way more in experience than you do in financial return, and going into it with that mindset. And so not setting yourself to lose a bunch of money, because we work hard and we have to save our money to have the down payment and have the amount to finance and do construction, all these buildings. But I think that's the right mentality for your first deal, is spend a dollar amount that you're comfortable with risking, but know that you're going to get a big education about it. And I think that is just super important for kind of first time investors to remember.
Yeah. If you think that you're going to quit your job after you buy that first property and you're going to get all this income, you definitely haven't done the numbers right. And yeah, you're right on. I think over time you can build it, and it needs to be more of a side hustle as you're building it out. And that's what it was for me. I had my day job. And then I got lucky, and that's something that we all benefit from. I totally say I got lucky on the purchase. You do make your money on the purchase. That was one thing I knew. And when I did my numbers, I said, this is just a no-brainer to buy this. And it was. And then get it managed, get it operating, get it generating cash flow. Now it becomes an attractive asset to sell to someone else.
Yeah. Part of the luck is finding that distressed seller, right? So finding that distressed seller is a big deal. Not everybody can find that, but
yeah,
if you, but I think this is great. I mean, your father was the broker, but if you're a real estate investor, a lot of them are making relationships with brokers and agents in the cities that they want to buy in. And, they're looking for those distressed opportunities. I mean, we had somebody on our podcast maybe a year and a half ago. He buys approximately in between 90 and 100 houses just here in Birmingham from real estate agents. Like, he does zero marketing. They all come to him with distressed, hey, this person needs to sell this fast. Would you give him a fair price? And he buys them. So luck and the
real estate agents love him, because they know if it's a deal, he's going to act on it. He's going to get it done. So they're going to bring in more.
And he keeps them when he flips it, he uses them to sell the property. So they make double commission. So it's a win-win.
And I also think it comes for me, I enjoy looking at real estate on the weekends, driving around neighborhoods, getting a feel for it, looking at listings online on the MLS that are either, expired or they've been on a long time, and trying to just get an idea of where those deals could potentially be. And, you might do that for 6 months or a year and not come across anything, but it's just kind of the way I like to spend some of my free time. I think it's fun. And I think then you come across a deal and quickly if it's going to work or not.
Yep. All right. So let's move on in the story. You took us all the way. You kind of gave us a short history. So you're at LifeLock and then you all sold. And so what was the idea for Neighborhood Ventures? Like was it meeting with your co-founder, John, and we were just talking about it? Was just like, talk about the idea to even start this.
So crowdfunding laws had just been passed at first at the federal level in 2013. And then it took a long time for the federal agencies to actually implement the law. Those weren't implemented until 2016. So a lot of states like Arizona came in and said, we're going to pass our own crowdfunding law. And in 2015, the state of Arizona has its own crowdfunding law. It's an intrastate law. So the property or the entity has to be in Arizona and all the investors have to be in Arizona, but it's a great law for folks in Arizona. And those laws had just been passed, and John and I both wanted to do more projects. So we were looking at, okay, we want to build a multifamily fund eventually. How do we do it? Do we go out to the country club and start talking to all our wealthy friends, which we have pretty big Rolodexes, and neither of us wanted to spend all the rest of our days schmoozing at the country club. We just, it did not appeal to me. I had already been doing that at my prior jobs, and I wanted to do something different. And we saw the opportunity that with the new crowdfunding laws, we could raise money online, we could put content online, we could build a following, and people could invest who have never invested in apartments before. Typically, you have to be an accredited investor to invest in a partnership in an apartment, and you have to have $100,000, $250,000. And accredited investors are folks that have $1 million in net worth, or they make $300,000 a year. So it's a small percentage of the population who really meet that threshold. We saw with the new crowdfunding laws, a new opportunity to bring a lot of other types of folks in. And we put our minimum investment at $1,000 on our first project. And we said, let's just see, we needed to raise, as John and I met, we found a project we really liked, small building. And we found that we needed to raise $500,000. And we said, can we raise $500,000, with $1,000 minimum investment? And we went at it, and it took us 6 months to raise $500,000, which is a long time. The seller was a friend of ours. He was actually a friend of John's and a long-term client. So he gave us some time. We tied up the property for 6 months, and he was about ready to say, okay, guys, your experiment didn't work. Let me sell this to someone else.
Did y'all explain to the seller what you were doing, saying, hey, listen, this is what we're going to do. We're brand new at this. Is going to take a little bit of time. So they were understanding.
And he supported that idea. And he said, hey, this will be a great project. I don't need to sell right away. We'd agreed on a price, and he gave us a little bit of time. And John and I decided we weren't going to allow ourselves to call our wealthy friends to fund this. We just said, let's see if this can work. And we can't juice it. We got to let it happen organically. And we did a bunch of investor meetings. We started doing Facebook ads. We started doing Google ads and trying to reach an audience. And one of the turning points was we were in an audience of about 100 people. And it was a big audience. And people were interested in what we were doing. And initially, we were going to give our investors common equity in the projects, which meant if the project did well, maybe they could get a 15, 16% return. If the project didn't do well, they might get a 4 or 5% return or a 0% return. And we're explaining this to folks that have day jobs. They're not professional investors. They're looking to invest maybe a few $1,000s. And then we explained also that one of our bigger investors was going to come in with some capital in preferred equity, and we were going to pay that person a fixed 10% return. And they were kind of confused by the common equity that could be up or down. And once we explained the preferred equity, we had a guy in the front row that said, well, look, I have about $5,000 I could invest, but could I do it in the preferred equity? The 10% that's just straight out of the gate 10%. And we said, well, that's not really how we've structured this, but we could look at that. And then someone from the back said, hey, I want that too. I want preferred equity at 10%. I'll do that. And me and John kind of looked at each other and said, well, we never thought about that, but let us get back to you. Let us go rework this. And we went back to the office, and instead of having the common equity, which again could be a good return or a bad return, we structured it at a 12% preferred return for investors, that they would get the preferred return. And what preferred means is they get paid first. So it's a lower risk investment, because the first dollars out of the gate after debt is paid goes to preferred equity. Warren Buffett loves owning preferred equity because it's lower risk, more guaranteed type of return. And we made that change, and we ended up funding about a month later, fully funding with 104 investors once we made that change. And since then, we've done 14 projects. 12% preferred equity is what we pay. If we achieve more than 12%, then that's our profit. But the investors get the first 12%, and our investors love that. And it works really well for us as well.
And so is there a waterfall split on top of the 12%? So this is 12% straight up. So y'all are taking a little bit of risk. So you've got to buy a good deal that should get you above 12% for you to make money and to pay your bills. But everything above that is gravy. And so what you found was newer investors are maybe risk averse. And so they say there's upside and there's downside, but I want to kind of cap my downside, so to speak, at 12, and they're willing to give up the opportunity of making more than that.
And then for us, we underwrite projects. We need to get a 16 to 20% IRR. And then if that works real well for us to pay them a 12% return, and then maybe we're getting debt at 5%, 6.5% now. But if we can get a 16 or 17% IRR deal, there's money for us on the table, profits for us after everyone is paid. And our incentive is very well aligned to make sure this project does well start to finish, because we don't get any type of return or management fee or anything until we have achieved and paid off that 12% preferred return to our investors.
It's interesting because it really was just a shift in your marketing, right? I mean, it was really just the message. All that needed to change was the message, because once you understand who your clients are, if you're going after like, hey, these are non-accredited investors. These are people that are like, hey, I don't trust the stock market and I've seen what it can do. But if you're telling me there's a really good chance I can make 12%, then I'll do that.
That's just it. And we kind of tried to do it the old way with, like Gray mentioned, a waterfall. And anybody who's worked in an investment that has an investor waterfall knows that they are extremely confusing to understand. Even if you have done them over and over again, it's kind of, now this piece goes here and this piece. So what's my return going to be? And that's what investors, so what am I going to get? And for us, it works a lot better to just keep it simple and say, look, you're just getting a 12% preferred return. If we do more than that, you're going to be capped, but you're going to get the first 12, and folks really responded to that.
Almost like hard money. They become your hard money lender at 12% rate. So opposed to equity, I mean, it's just kind of another way to look at it. But at the end of the day, they're probably very happy to get 12% on $1,000 to $10,000. What is the people that are investing in this? Like, what's kind of the typical profile? Why are they investing in this opposed to doing maybe direct or active deals on their own?
Yeah, we have a lot of investors who have done deals before on their own, and they've kind of grayed out and they don't want the hassle of managing properties anymore. We have a lot of busy professionals that want to diversify their portfolio and invest in real estate. And this is a great option for them. They can put $5,000 in a project, and we do 4 or 5 projects a year. So we have a lot of folks that started with $5,000 and now they have $70,000 with us, and they love that. They have good diversification because that's over several projects. And our average investment is about $6,000. We have several folks that have millions with us as well. So we have big investors who really like our model. They like that 12% return. And then the other thing that we found was once a building went kind of through the full cycle and we renovated the building, because our projects are primarily value add buildings. We renovate the building, we increase the income that it's generating, then we end up selling the building. And that's when folks get their investment back. A lot of our investors were saying, well, wait a second, now you're selling the building. I really liked owning that. And I like that building. Why did you sell it? And the first few, you have to sell the building to give everyone liquidity, including ourselves. We needed to have them go for a full cycle. But we looked at some of those buildings and said, we would really love to hold that for a little longer. There's more juice in that asset, but we were in a position, it was structured where we had to sell. And that's why we created NV REIT, Neighborhood Ventures REIT. And what that does is it's open for investors nationally. So you don't have to be an Arizona resident, which is how we raised capital in our original projects. And it's $1,000 minimum investment. And with the REIT, part of the reason we created that is that the best projects that we run, instead of sell those to an outside party, the REIT buys out the equity in those projects. And so these are only projects that are cash flowing and that we plan to hold for 10 years or more. And the REIT we just launched in January, it made its first acquisition last month, which is one of our best performing assets that instead of selling it off, we sold it to the REIT. And we're really excited about what the REIT will do going forward. And it gives our investors another option of another way to invest.
And the REIT gives a little bit lower return. Is it like when people are investing in the REIT, what is their mindset? Like, so why would they invest in the REIT? Well, I guess because it's open nationally. It's open nationally.
Yeah. But a lot of our Arizona investors have decided to invest in the REIT after investing in individual projects. It's a little bit simpler because some of our investors have an investment in all 13 of our projects, which means they get 13 K1s at the end of the year. With the REIT, they can invest in one entity, and it's a diversified portfolio. We expect it to be ultimately 10 to 15 assets. And then the REIT also offers upside. So as we mentioned before, the individual projects we cap at 12%. The REIT is only going to acquire stabilized cash flowing assets, and it's paying out 5% cash flow right now. And investors receive 80% of the upside over time. So we will take 20% of the upside as those assets go up in value, but 20% of that stays with the investors. And that's another thing. Many of our investors love the preferred return at 12%. Others said, well, I'd like to see some more of this upside. If real estate, if the value of these things go up, can I get a piece of that? And now with the REIT, they can. They get the first 6% preferred. And then all of the other proceeds are split 80-20, 80 to investors, 20 to us.
That's interesting. How long is it? Go ahead, Gray.
And that's of the cash flow, not having to go full cycle and sell these assets. And so as you increase the NOI in the building and it hits the 6% return, and then that waterfall, and that's when we say waterfall structure, it's above 6%, then you have a split of profits, and 20% goes to Jamison and 8% goes to the investor.
Yep. And then we also do quarterly, we take a look at the portfolio, the total portfolio, and we value everything that is held in the portfolio. and we publish the price per share of the REIT stock share price every quarter. And so as the buildings move up in value or change in value over time, they don't have to wait until we sell a building to achieve that upside. So if 5 years down the road, they want to pull their money out, we offer redemptions, and that will be based on the share price that we value the REIT at.
It's interesting. What do you know about, because this is, you're operating in Arizona. What do you know about other crowdfunding laws around the country? And are you thinking about like moving outside of just Arizona?
So the REIT is a crowdfunding offering, but it's managed or regulated by the SEC. It's an SEC Reg A offering. So it took us about 6 months to get it approved through the SEC. And that doesn't mean they endorse the investment, but it does mean that we went through pretty rigorous background checks and other things to be able to do the offering. And so this is also crowdfunding. You don't have to be an accredited investor to invest in the REIT. And the way that it works is folks can invest 10% of their income or net worth, whichever is more, in the REIT. So if they have a $75,000 income and a $25,000 net worth, they can invest $7,500. And if you're an accredited investor, you don't have a cap. So
Gotcha.
In order to do crowdfunding nationally, you need to do a Reg A offering like this. You can also post individual projects on national crowdfunding portals. A little bit complicated. We didn't love that route. So there's a partner we work with, Small Change. They're a real estate portal for national crowdfunding offerings. We did a little bit of work with them, and they do a great job, but we decided to just go directly to a Reg A offering for the REIT.
And how long does it take you now to raise a typical, like one of your, not the REIT, but raise a typical project with your Arizona people?
So we actually launched a project on Tuesday, and in 24 hours, we hit our target raise of 1.5 million, 160 investors. So we built up a good pool of investors that the first 24 hours we hit our target. And so it's getting a lot faster now, and
slightly faster.
Six months to 24 hours.
How many of those 100? Sorry, go ahead.
It makes the stress is a lot less. I love being able to see that come through in 24 hours. The 6 months, I don't want to do that again.
How many of those 160 are repeat investors?
80%. So
what I would assume, if you're doing good work, you probably have a pretty high rate of investors that are returning.
And we do a lot of outreach to bring in new investors, and then a lot of them will follow us for a while and they're watching us, but they're waiting for the next project. But most folks, 80% of them are people who have invested with us before. We have a handful of people who invested all 14 of them. And we love those folks because they've been with us since the beginning.
Do you ever go out? Do you ever look to raise? I guess you don't really have to. I mean, you've kind of chosen your path. It's not the country club, so you don't need to go to your Rolodex per se. But you've just got this crowdfunding, and I would imagine a lot of people, or some of that 20% would come from word of mouth from the other 80%, right? So this their friends and their family who they're also saying, hey, you need to get in on this.
By far, over 50% of our new investors come from word of mouth. And we do some advertising and some marketing, but word of mouth is our biggest thing. And we love our accredited investors. They like the fact that everything's online. It's very automated. To bring in 200 investments in 10 hours is a big, complicated process if you're doing it the old way. It takes about 5 minutes for an investor to go into our portal and to set up their investment. They can then log in and they can see all their positions and they can see the performance. So a lot of the accredited investors have been attracted to that, as well as kind of our transparency. With crowdfunding, everything has to be very transparent because everything has to be online. So there's no, I'm giving Joey a good deal over here. I'm going to tell him this, and I'm going to tell Susie this. Everything's online. So there's no ambiguity in what the deal structure is, what the deal looks like. And I think folks really like that transparency as well.
So what's the future look like? Like, what are your goals? What are you looking at next 5-10 years?
So with the REIT, we can raise $75 million. Our target raise is $50 million. That's about 12,000 investors. And so over the next couple of years, and we have a few years to raise the capital for the REIT. So that is our next opportunity, is to go outside of Arizona to talk to a broader crowd and talk to those folks and build our audience and bring in 10 to 15,000 investors in our REIT. And we're really excited to do that. We just launched in January, and so far we've hit our goals of the amount that we're raising. We don't publicize that. The cool thing about our local projects is you go online and you can see how many investors in real time have invested, and you can see it. The REIT's a little bit different for some reasons. We'll update that over time, but in real time, it's fun to see that move. But with the REIT, we've had a great start so far, and I think we're very confident that we'll bring that many investors into our partnerships. But it's a lot, when you're trying to raise capital from folks, it takes time. There's an educational process, and we have no sales team. We market, we put out a lot of content. We do podcasts like this. And then when folks are ready to invest, they do it on their own. We don't have anybody that's in a boiler room trying to raise capital for us.
No boiler room. That's great. Well, this is awesome. How do people learn more about what you're doing, Jamison? What's the best way for them to learn more about the REIT and the opportunity?
Everything is on our platform, which is our website, neighborhood.ventures. The website's real easy to get around, but you can see the information about the REIT. When you want more information about it, the details, you create a login and it gives you access to the portal so you can see all the information about it. A lot of people first subscribe to our YouTube channel. We put out some really cool content about our projects, videos, and that's where a lot of people end up starting, is following our YouTube channel, listen to our podcast for a while. And then, when we do new offerings like we did this week, that's a fun time because we hear from a lot of folks who've been following us that we didn't even know they had been, and now they're ready to invest.
I love that. I think that's a great way to do it. I think that's a great way to market, is to educate and give away as much free information as you possibly can, help investors make really wise decisions. And then, it ends up coming back to you, I think.
And the great thing about multifamily is a lot of people understand it intuitively. And one of the things we talk about is don't invest in something you don't understand. I had a lot of friends that were trying to get me to put money in Bitcoin and other things. And I said, I just don't get the intrinsic value. And I looked like an idiot for a while, and now I'm glad I did. Maybe I should put some money in there. I just don't like investing in something I don't understand. And I think that the great thing with multifamily is in some of these markets where, at Phoenix, 100,000 people move here every year, and they need to live somewhere. And so we're just going to continue to see the demand for multifamily. Millennials are okay living in apartments. 25% of them say they're fine living in apartments the rest of their life. They like the flexibility. They like being able to move to a new job without having to sell a house. Their apartments are becoming kind of cool. And so I think it's an asset people can easily understand. They like owning them. And, people have to live somewhere. They value that. So I love it as an investment.
Yeah, I agree. I think the demand just keeps increasing. So Jamison, man, thank you for being on the show. This has been fantastic. Love learning about it, and best of luck to you.
Hey, thanks for taking the time. You guys know your stuff, I can tell, and I look forward to continuing to listen and subscribe to the podcast.
Awesome. Well, all right, everybody. Thanks for listening to the show, and we'll be back next week with another episode of the Evernest Real Estate Investor Podcast.